Good afternoon, everyone. Thanks for joining us today for our webinar, Startup Fundraising Workshop, Pitch and Model and Fundraising as a Process, presented by Early Growth Financial Services and Foundersuite. My name is Jason Kennedy with EGFS. I will be your moderator for today. A few housekeeping items before we jump right in. As is usual, these webinars take about 60 minutes with time baked in for Q&A at the end of the presentation. If you do have questions throughout the presentation, I encourage you to use the questions panel in your GoToWebinar console, and we will get through as many questions as you can during the presentation. If we weren't able to get to your question by the end, we will have contact information available up on the last slide so that you can reach out to us, and we're happy to get any questions you might have answered. A recording will be made available and automatically emailed to all registrants within 48 hours, so keep a lookout for that. We also put up a copy of this recording, as well as all of our previous webinars, on the Early Growth Financial Services channel over on YouTube. So with that out of the way, we'll jump right in, and we'll start with meeting our distinguished panelists for today, and we'll start on the EGFS side with Sirk Rowe, Principal and Consulting CFO with Early Growth Financial Services. Sir, good afternoon, and say hello.
Good afternoon, everyone, and thank you very much for joining. Just a couple of descriptions about our company. Early Growth Financial Services is an outsourced accounting and financial services company. We work with small and medium-sized companies, which in most of our markets typically means high-tech startups. That's our sweet spot, working with venture-backed or seed finance companies who really don't need to be hiring people in an administrative or financial function full-time, but still want and need the services of a qualified financial firm. We provide 4 basic services. We do tax returns, corporate tax returns, as well as individual tax returns. We do company valuations, so 409A valuations, for example, for companies who offer stock options to their employees and who need to be valuing the common stock on an annual basis. So we provide that service, and those two we provide on a per service basis. And then we also provide on a consulting basis both accounting services as well as CFO level services. And typically we come in as a team of 2, a CFO and a senior accountant, and we basically become the de facto accounting department for our clients. And so we provide a value add service where we can come in and work on an as needed basis. So spending less of your precious dollars initially to really get the accounting and finance functions up and running and supporting the company and growing with the company until you require the services of full-time people.
Great, thank you very much, Sirk. Our second guest today, Nathan Beckert, CFA with Foundersuite. Nathan, say hello and tell us a little bit about Foundersuite.
Yeah, hello, thank you. Nathan Beckert, I'm founder and CEO of Foundersuite. We're about a 2.5-year-old company. We make a SaaS platform for startups that are raising capital and managing investor relations. So we've got a couple products in our software suite. We've got an investor database of about 50,000 names, both angels and VCs, that you can search by market tag and location tag. And that's, of course, to help you build your funnel. We've got an investor CRM, which is a Kanban board style of CRM for managing your investor funnel, managing your pipeline of investors, all the discussions you're having with investors, keeping on top of all that stuff. And then we have an investor updater tool, which is to do your monthly or quarterly update reports to both your existing investors and to prospective investors you're trying to warm up and keep in the loop. In fact, I just sent out our quarterly update to our own investors about an hour ago, and then I can track and see who's looking at that. So those are our products: Investor CRM, and Investor Updater, and investor database. Before launching Foundersuite, I ran a consulting business called Venture Archetypes. So it was like a miniature version of early growth financial services. We were about 8 people at its peak, and we would help startups that were fundraising. We would, have a company come in, we put together their model, their deck, put together a list of target investors, and we help them kind of figure out their fundraising strategy. And I did that for about close to 12 years. Worked with over 120 companies, raised money, and cumulatively raised about 120 million. So kind of been fundraising for forever, pretty much, and kind of live, breathe, and eat this stuff. So hopefully, I can share a few tips on how to effectively raise money.
That's fantastic. Thank you very much, Nathan. Welcome to both of you. So let's get started here, starting with a couple of very key components of fundraising, especially for early stage companies, the pitch deck, and particularly within that, the financial model and what that looks like. And Cirque, let's just talk about high level, like what investors are looking for, like what you should be presenting to investors.
Sure, absolutely, Jason. So as you start going out and thinking about what you need to prepare in anticipation of obviously meeting with investors and pitching your idea, these are basically the 3 things that you're going to have want to have prepared, as well as really know cold. Right, and the first thing is the elevator pitch. And for those of you who are not familiar with it, that's basically that 30 to 60 second message. If you're stuck with someone in an elevator and someone asks you, so what do you do, or what does your company do? You should have a 30 to 60 second canned pitch, which really describes the company, the vision of the company, and really acts as kind of the a sales tool, right, for someone to pique their interest and to have them want to learn more about your company. And basically that's what all of this is. These are all sales pitches, right? The second thing is the executive summary, and this would be a 1 to 2 page document, that is again a sales tool that asks anyone looking at it to want to take the next step and learn more about your company. And this is where you will, state some of the facts about your company, the market you're going after, the vision that you have. You'll mention the team that you have. You'll mention the progress that you've made. You'll state on there kind of what stage you're at and how much you're looking to raise and what you're looking to do with those funds. On the executive summary, the key thing that I always tell people when they're putting it together is, it shouldn't just be a fact-based document, which is kind of the easiest thing to do, which is just to put down a bunch of facts and to just kind of regurgitate, right, and to hope that draws the attention of anyone looking at it. But it really should be a sales tool, right? So it should talk about the vision of the company and what you're trying to do and what the company's about and the markets that you're trying to reach, the problem that you're trying to solve. Such that someone who's looking at this and reads it will definitely be intrigued. And if they're an investor, then it'll want them to take the next step of meeting with you and listening to your entire pitch. And then the final thing is obviously the pitch deck, which is a 10 to 12 slide. I like to say 10 to 12 slide. It's usually hard to fit everything that we want to say, but this is going to be your 20 to 30 minute presentation for when you are actually meeting with investors, potential investors, to really walk them through your entire presentation of what the company is about. Again, the vision that you have, the problem that you're trying to solve, the solution that we have, and a call to action for the amount of money that you're going to need, and what you're going to be doing with that money. And so this is kind of the key thing that you'll be presenting. I think the next slide, before we go to that, the 2 references that we always state are these 2 books, one by Guy Kawasaki, Art of the Start, and the other one by Mark Phillips, Inside Silicon Valley. These are 2 books that really go into detail about, both the, what investors are looking for, how you go about navigating to meeting with investors, what the pitch deck is going to include. And if you're not familiar with these books, I certainly encourage you to look them up and spend some time going through them. They are both great references.
Yeah, those are fantastic, especially around building the pitch deck specifically. And Cirque, we actually have like a webinar we do just around this slide. So we're going to try to condense as much of that as possible into kind of these key points, these key slides. Can you run through these really quickly for us, like what typically needs to be in each one?
Yeah, absolutely, Jason, and you're absolutely right. We could spend an hour or two just kind of going through the actual slides in your pitch deck. But for brevity's sake, these are the kind of the main things that you're going to want to include in here. And here's an example with 10 slides, 10 to 12. We encourage you not to go too far into depth. You want it to keep it high level. You want to keep it visual. Obviously you're going to have a lot of backup information to dive into. If questions get into some more detail, then you'll want to have that. But as your main presentation, you're going to really want to try to keep it to 10 or 12 slides. You start with a cover slide of your mission, your vision, a little bit about your company. Big thing that you're going to want to identify initially is, what's the problem that we're trying to solve, right? And what is our solution to that problem? We see too many companies, or we see companies that have great solutions, very elegant solutions, right? But not necessarily with a big enough problem that they're trying to solve. So it's just not a compelling investment opportunity. And here's one where I really love the visual of, okay, here's what it looks like today, right? This is what the world looks like today, and this is what the world will look like, once our solution is in the market and people are using our solution, and that's a great visual if you can kind of make it into something like that. Obviously, a market opportunity. So talk about what the market is like. The segments of the market that we're going to be able to play, and obviously the key message here that we want to convey is that we have a big and compelling market opportunity that we're going after. The strategy, obviously, how we're going to attack that market. And this will be, probably a little bit of a combination of, our knowledge about the market, our knowledge about the problem, the elegant solution that we have, and why it's going to meet the market demands. You'll want to talk a little bit to the extent that we have any kind of built-in special sauce that we are using in our solution. We'll want to talk about a little bit about the technology and why it's the best solution for the problem that we're trying to solve. Have to have a competition slide. The two main ways that I see this being presented is in this format here, which is kind of a classic one where you list your competitors on one axis, you list the benefits or the details of some of the solutions on the other axis, and you state why. Obviously, we're going to want to show that we address all of these issues, whereas some of our competitors maybe don't. And so this is kind of a checklist. The other way that I've seen it introduced is using kind of like a quadrant, right, where you list two axes with benefits on both axes, and then we show that we are kind of up in the upper quadrant, whereas some of our competitors address only one or the other benefits. You'll want to talk a little bit about your financials, right? About what the opportunity is, where we see our revenue going. You'll probably want to put in here not only the revenue potential, but also of cash requirements and what we're going to be doing with the cash. And then the funding requirement is obviously an offshoot of that, where we basically are asking for how much money we're going to need in this round and in the future, and what we're going to be doing with that money. So the use of the proceeds is a key one. You know, are we looking to build out the product still? Is it a seed stage where we've done some work, but we need to really fill out the product? Are we in a go-to-market stage where we're now really going after customers and spending a lot of the money towards marketing and towards customer acquisitions? So we obviously need to be, you know, telling our investors what we're going to be doing with that money. The milestones is a really key one, right? So we talk a lot about, excuse me, we talk a lot about milestone-based financing, where we say, look, you know, we're raising a certain amount of money this round of financing. These are the milestones we're going to hit with this financing, and then these are future milestones that we're going to hit with next rounds of financing. And the key here is that as we reach these milestones, that's when we kind of see these big step function increases in valuation. So the key is to try to raise enough money in this round to hit some milestones with it, such that when we go after the next round of financing, we're doing it after hitting these milestones. And so we're raising the next round of financing at a much higher valuation than we raised in this one. And then obviously, you know, some mention of the management team, you know, of the technical expertise, the market expertise, the industry expertises that we have within our management team that is going to be able to take advantage and be successful. And management team here is you know, especially in early stages, is really key, because that's really what investors are investing in. They'll probably have seen other companies that are doing something similar to what you're doing, because the investors see, you know, lots of opportunities. And so, you know, all this other information is really obviously important, but really being able to sell them on the management team is going to be critical.
So a fun question I like to kind of throw out, you know, to folks such as yourselves, Sir, Nathan, I'll ask you both, but and it's kind of a gut check for anybody out there with that really bloated pitch deck. But what's in terms of number of slides, what's the largest pitch deck you've seen recently? My answer, I saw one recently that got a cold email to me that was 55 slides long. Sir, have you seen one that long?
I haven't seen. No, I haven't seen one that long. I see, you know, 20 to 25 page pitch decks, you know, regularly, and I just encourage you to really, you know, if you think about it, you know, you have to hold the attention, right, of the listener or the audience. And the way that you do that is you really keep it high level. You want to make your points, but you want to have the ability to have questions be asked and for a discussion to ensue, right? And so, you know, some of that information really belongs in backup slides that you're not going to be presenting, but that you would be able to pull up, right, during the presentation if the audience wants to go a little bit more in depth. And certainly during due diligence, when there's a little bit more detailed discussions about some of these things, you'll go into it, but not for your initial pitch deck and not for your initial 1 hour meeting with investors. Because if you think about it, right, you're going to want to have a pitch deck that you can go through in 20 to 30 minutes. You need to allow for question and answers. If the presentation is successful, there will be questions being asked, and you're going to want to be able to have time to answer those and get into discussions, because that's really when you've really done a good job in doing a presentation, if the investors are really keen on the idea and want to find out more. Nathan, do you have any idea?
Nathan, what have you seen recently along those lines?
Yeah, I admit whenever I've raised money, I've always had decks that are probably on average about 24 slides, but most of that, at least half, is usually the appendix slides, right? So I always build a deck, and then I kind of go through this process of actually inserting a slide called appendix, and then try and move everything, or as much as possible, from my decks into the appendix. So like Cirque is saying, you know, the core guts of the actual pitch is only 11, 12 slides. And then I further take that deck, which is now, say, 11 slides in the main body, 12, 13 slides in the appendix, And if I'm ever sending that deck out to people, I cut off the appendix altogether and just send out the core 11, 12 slides. When I go into pitch live, I have the whole deck. That way I can refer to those appendix slides pretty easily. So that's why I crack that.
Nice. Yeah, all good feedback and insight there, gents. Thank you very much. So, Cirque, let's get into the meat and potatoes of what we do here at EGFS in particular and talk a little bit about the financial slides.
Yeah, and that's obviously where we do a lot of work with early stage companies. On the financial sides, I mean, these are kind of the four main things that you're going to want to include, right? Which is the financial model. You start with the financial model with revenue projections, and we'll kind of talk about how you come up with revenue projections in the next couple of slides. But what we need to understand, right, as the entrepreneur and as the person who's presenting this pitch deck to investors is, okay, this is what our business looks like, right? This is how much revenue we're projecting, when the revenue is going to start, or how that revenue is going to grow. What's the basis for that, for those assumptions, being able to back that up? What are the expense structures that we need underneath that revenue projections, both on the cost of goods sold as well as operational expenses to support that revenue and to generate that revenue. And then near and dear to my heart, because of the fact that obviously cash is key. Doing a P&L or an income statement is all well and good, and you obviously have to start there, right? But I really, really encourage entrepreneurs as early on as possible to put together a financial projection that not only includes the P&L or the income statement, but also a balance sheet and an accompanying cash flow statement. And the reason for that is because depending on the kind of company that you have, the cash that's being the cash that gets used up, that gets sucked up as a company grows, will reside. A lot of it will reside on the balance sheet. Whether it's fixed assets that you have to purchase. If you're a company that produces a hard good, then there will be inventory, right? So cash gets sucked up in inventory. If our revenue is growing and we have customers for whom we give terms and they pay over time, or they pay a month or two after they get an invoice, then we have to take into account the increasing accounts receivable balance that sucks up our cash. So doing a balance sheet forecast as well as an income statement forecast really drives home to entrepreneurs how much cash they need, right? Not just, hey, how much am I making or losing every month, because that's going to tell me how much cash I need. That's not necessarily the case. In some cases, it's a pretty good proxy, but for other companies, it's not. And so I always encourage companies to spend some time doing that. Initially. And from that, basically, the bottom two points here, the funding requirements and the use of funds milestones, will get kicked out, right? You'll see, okay, if I'm trying to raise funds for the next, 12 to 18 months, and I really believe in my financial model, this is how much I'm going to have to raise now, so that I've got a 12 to 18 month runway for which to run my business, to grow my business, and to hit these milestones. And again, to really focus on those milestones, write them down, make a commitment to yourself, make a commitment to your investors. These are the milestones that I'm going to hit. And when I hit these milestones, I guarantee you that the company is going to have a much increased value, so that when we go for the next round of financing in 18 months, then we're going to do it at a much higher valuation. And the investment that you're making today is going to be worth more.
Great, fantastic. So real quickly, let's jump into a couple different financial projections, starting with the top down.
Yeah, I'm not going to spend too much time here, but basically, from a tops-down financial projections, this is kind of where I would say that you'll want to do something like this, especially at an early stage company when you don't have a lot of history to really kind of, extrapolate a potential revenue or what our revenue might look like. And so you kind of start with, a market size, a total market size, or a TAM, a total available market, and you kind of funnel that down, right, to say, okay, well, this is the segment I'm going to initially go after, or these are the 1 or 2 segments I'm going to go after. And then you basically say that I'm going to be able to capture this amount of this market over a certain amount of time. And so you can kind of start with that to say, okay, these are kind of the revenue projections that I might be able to achieve, and you do it at a tops down level. Obviously you're going to want to be able to back up the assumptions that you're using, and you're going to be able to support it, right? You're going to have to be able to say, hey, this is why I'm going to be able to get 0.5% of the market size in the first year, and it's going to increase to 2% or 3% in the following year. You're obviously going to have to support that. But at a very least, if you don't have a lot of history, then you can at least start with this to kind of give you an idea of what the revenue projection might look like.
All right, great. So top down, let's flip it and talk about bottom up.
Yeah, and this is the one where it's all well and good, obviously, to put together a revenue projection, but you really have to be able to support that not only from the revenue side, but then how much spending do I need to how much hiring do I need to do? How much spending am I going to have to spend to be able to generate that revenue and to support that revenue, right? So customer acquisition costs and churn. If you have a SaaS model or a software as a service model, for example, understanding what it takes to actually acquire a customer, understanding how long that customer is going to stay with us, the lifetime value, the amount of churn that we're going to have on a monthly basis as we continue to grow our revenue base. All those kinds of assumptions are going to be critical in us determining how much spending we're going to have to do, and clearly those kinds of numbers, the ratios, the investors are going to be looking at that to make sure that not only is it a supportable business from a financial and investment perspective, but that as an entrepreneur that we understand what the business looks like and how the business is going to grow over time, so that again to get the confidence, to gain the confidence of investors, knowing this stuff cold, and having some firm backable assumptions in your model in your financial model is going to be critical in you gaining that yes from the investors.
All right. So we've touched a little bit on kind of the financial side of things. Nathan, I'm going to kind of kick it over to you and let you kind of take us through the process itself. Fundraising, like what to be looking for, how to jump in. So I'm gonna kick over the pointer over to you and let you kind of take it away.
Great. Can you see my screen okay?
All good.
Perfect. Okay. No, that was really good. I really liked that discussion. When I mentioned I spent about 12 years working with startups, getting them ready to go fundraise and then helping them on their rounds. And we would do that exact process. We'd go through and build that slide deck, and you really get in deep with the company when you help them put together their slide deck. And then you really get into the numbers, and putting together that financial story is so critical if you want to be able to intelligently get out there and go talk to investors about what your business is, how much you need to raise, and where that will get you. So once you've gone through those steps that Serge just outlined, that you have your materials and model and pitch ready. Now it's time to actually run a process. We always talk about running a process, and the reason is because it avoids this issue. A lot of startups and founders will get out there and they'll just start asking everyone they know, hey, can you connect me to some VCs? And there are a lot of problems with that very loose, ambiguous approach. One is, as Hunter Rock puts out here, it's too ambiguous a question, too broad a question to be acted upon. It's also putting all the work of figuring out who you should be talking to on the shoulders of the other person. So instead, we like to run it as a process that if you look at B2B sales or enterprise sales, it's a very clear step-by-step approach that a salesperson takes. They build a list of leads, they qualify those leads, they engage with those leads, and they ultimately drive them to a close. And fundraising is just another version of this. It's running your fundraise as a funnel, thinking about it as a funnel where you're putting together this list of investors, screening, filtering, qualifying them, figuring out the right person, especially if you're pitching a fund. You got to find the right person at each fund. You don't just pitch a fund. Figuring out how to reach everyone on this list, very, very important. Then, of course, getting into the discussions, the outreach, the pitch meetings, everything we just talked about here. You're ready with your model and your pitch. Hopefully getting into due diligence, where they're going deeper into your business, and ultimately you're selling shares of your company. So when we talk about running a process, it's really thinking of your fundraise as a funnel. So step one, I'm going to go through this fairly quick, and then we have plenty of time for Q&A at the end. Step number one, of course, is actually building this funnel. Especially if you're at the seed round, I usually advise, you need at least 100 names in your funnel, the top of your funnel. More often that's like 200 or even more sometimes. When we raised our seed rounds of about $1 million, I pitched 200 investors and ended up with 1 seed venture fund and 10 angels. So you can do that math. That's about a 5% commit rate, 5% conversion rate. Also means you're getting rejected 95% of the time. So all that combined is why you need a pretty healthy, top of your funnel. The AngelList is very useful for that. There's roughly 24,000 or so investors on AngelList, and you can search by different criteria. Within our platform, Foundersuite, we've built a database of about 50,000 investor names, both angels and VCs, and they are tagged by market tag or location tag. So you can search by financial tech or drones or whatever it may be, and also by location. And then we pulled in their social links so you can do a little more digging on your own. CrunchBase is pretty useful for building your funnel. The way I like to use it is to put in companies that are similar to mine but not directly competitive, and I go and see who funded them at my appropriate stage. It's also useful if you have maybe a seed fund involved in your deal. You can go in and see who they typically co-invest with. So also useful to build your funnel. A few other places I'm just going to point out very quickly. PE Hub, Inside Venture, and Venture Pulse are all free email newsletters you can subscribe to that announce various fundings, and so you can go see who's investing in whom, and oftentimes that'll pick out, we'll show you a few different names to add to your funnel. Conferences are also useful. Basically, the hack here is to find the leading conferences in your space, especially if you're in a new or emerging space like artificial intelligence or CRISPRs or something. Go see who's speaking at those conferences, and more often than not, it'll be a bunch of investors who like to build a brand for themselves, build their deal flow by getting on the conference speaking circuit. Quora, Medium, these are all useful. People have answered a lot of questions on Quora. PitchBook, MetaMark, and CB Insights are pretty expensive paid databases, but they're all very good. I like PitchBook a lot. I think it's about $50,000 a year though, so you need to have a friend who's got access to that, but really detailed investor information on these databases. And then your own personal network. The two kind of hacks here are to, actually I think I have a slide for this, to go into your own LinkedIn and just in the search bar at the top, put in investor or angel, and then come over here and do second degree connection and then pick a location. And it will show you everyone who you theoretically could get an intro to because you have a mutual connection. So LinkedIn's pretty useful. Another hack, if you're using a CRM like Foundersuite or some other CRM, is to actually go in and invite your advisors and mentors and any existing investors to come into your account and add people to your investor funnel. I've done this pretty successfully where I actually give my advisors and angels their own column, and I ask them to come in and populate that column in our Kanban board with investors from the network, and it generated about 50 warm intros. Okay, moving through this pretty quick.
Hey, Nathan, can I just add one comment to this slide? You know, one other place that I always encourage, and maybe it's because this is kind of what we do, is, you know, if you're an entrepreneur that has a company that is ultimately going to be or are looking for venture financing or seed financing, you should be, I mean, anyone that you're working with, all of your service providers, all of your partnerships that you have, right, should be potential sources of introductions and additions to the funnel. So, you know, key one would be, for example, your attorney, right? So, you know, some entrepreneurs like to try to save money by going with a local law firm, whereas if you go to a law firm that is in the venture space, you're gonna have your attorney is going to be able to make introductions for you. You know, same thing with early growth, right? We're a financial services company that is in the ecosystem, that is part of the ecosystem of venture-backed companies, right? And so we know tons of investors, and we can make introductions. So anyone that you're talking to, sure, they should be able to provide whatever service. Banks is another one, right? You know, your banker, if he or she is really good and tied into the venture community, should be able to make introductions for you. So think about that, you know, when you're actually talking with potential partners or service providers, because they should be a source of introductions for you as well.
Absolutely, I agree. You really have to uncover all the stones and, you know, leave no stone unturned, as the saying goes, when you're fundraising, and really kind of work your network. I mean, I'm going to show you something really quick. Just show you my own board in Foundersuite. But you see here, I have this column called Steve B. Leads. This is where I got Steve Bennett, who's a professor and advisor. He came in and he added 20 people to my board, and you could repeat this process with the guys from Early Growth Financial Services, with your attorney. If you get 10 to 20 leads from everyone who's advising you or you're working with, your service providers, you know, that adds up pretty quick, and you've got a pretty nice funnel. So, okay, good stuff. I like that. Work your network is the short version. So once we've got a pretty good list here, we actually want to, you know, sticking with this metaphor of being a good salesperson. Good salespeople spend a lot of time qualifying, filtering, prioritizing their leads. They don't chase every lead equally. We want to do the same with our list of investors. And so, and this is really important because it'll save you a ton of time later. It will also help you generate more momentum for your round if you've got a really high quality and well-qualified list of investors. You'll be able to generate more momentum for your round, which ultimately, you know, increases your odds of raising money. So just a couple things here to be mindful of. You know, removing anyone who's invested in a competitor, right? You go into their portfolio section on their website or their AngelList page, you see someone who's directly competitive, just don't even talk to them. It serves you no purpose. If they're a venture fund and they have not raised a new fund in the last couple of years, they're probably only doing follow-on deals to their existing companies. So this is what I mean by no dry powder. You might take them off your list or put them lower on your list. Conversely, venture funds that have just raised a new round often are eager to put that money to work. It might, you know, bump them up on your list. Same with Angel. If you look at their AngelList page, they haven't done a new deal since 2014. They might be taking a break. I wouldn't spend a lot of time chasing them. And then wrong sector, wrong stage, wrong geographic location. This just comes about from kind of studying your target investors, looking at what they invest in, looking at, you know, what they state specifically on the website, but also looking at their portfolio and just making sure you're a right fit for them. So again, spend some time kind of trimming your list before reaching out. It'll save you a lot of time and help you generate that all-important momentum. Okay, once we've kind of got this nice, well-qualified list, we want to figure out how to reach everyone on this list. And this is, you know, we spend a lot of time in LinkedIn doing this, basically just plugging the investor into LinkedIn and then seeing who you have in common. If you have multiple people in common, multiple connections in common, Then there's a hierarchy of intro sources, and I'll just go through them very, very quick. But the first one is someone who's made the investor money in the past. Always your best source for an intro. The investor will take that intro all day long, every day, be very responsive. Someone they've co-invested in the past with, also useful. Someone they've invested in, like another founder, is a good source for getting an intro, because that investor has spent the time getting to know that person, they trust them, there's a relationship there. You know, at the risk of being offensive, maybe a little bit further down the list are the service providers sometimes, you know, only because they tend to make a lot of intros. Sometimes it might not be quite as strong an intro as someone who's, you know, made that investor money in the past, yet still very solid. And then kind of way down the list are people who that investor doesn't even really know. Maybe they met them at a conference, or, you know, kind of casually connected to them. So there's your hierarchy of intro sources. But again, sometimes you have to just lean on who you know the best, and get them to make that intro. The cold email is way down the list. I strongly recommend doing cold email. These guys and gals, these investors are already getting 50 to 100 warm intros a day sometimes, so your cold email will often be ignored completely. All right, moving on. We need a tracking system. If you followed along, you've got your model, your pitch deck ready, you have this really nice qualified list of investors. You figured out how you're going to reach everyone on your target list. You know, you might be having 100 to 150 intros and conversations in the next month or two. Need a way of tracking all this. This is what we used to build back in the consulting days, the spreadsheet, which is fine. It gets pretty messy and bloated pretty quickly when you're actually in the heat of a fundraise. My little product placement is we built Foundersuite, which I just showed you, to manage your fundraise much more efficiently as a funnel. And there's a free version of Foundersuite, so check that out. But, you know, I tell people, whether you use Foundersuite, which of course is what we want, but maybe you're already a Salesforce expert and you want to repurpose Salesforce for your fundraise, you need some way of staying on track of all the discussions, calls, meetings, tasks, due diligence items that are going to be happening, you know, very soon in your fundraise. And you will lose momentum if you don't have a good way of keeping on track and running an efficient process. And once again, fundraising is all about building and keeping momentum. So, you know, if you have friction in your fundraise because you're using sticky notes and a messy Excel sheet, you know, things are going to slip. Okay, now step number 5. We are ready to really jump in full force to fundraising. You know, you've just figured out that your contact at Early Growth knows a bunch of your target investors, and now you want to ask Cirque or Jeff for a bunch of intros. This is a sample email I've used. Jeff is actually a friend of mine who works at NASDAQ. He knows a lot of investors. And so I put together this list for Jeff. Hey, Jeff, these are all the people I've found in your network that I want to meet. Do you know them well enough to make an intro? Jeff can very quickly respond back, yes, no, don't know this person, you're too early. Takes him just a few minutes. And when you're asking important people, connected people for intros, you want to make it easy for them. So now Jeff or Sir or someone else said, yes, I will do these intros. I know these people well enough. For each of those people that is on your target list, you want to have a nice clean email, something like this. This is just an example. Jeff, can you introduce me to target investor, a little bit about who we are, a little teaser. If you have some commitments in your round already, if you have some really exciting momentum, put that in the subject line. You want to have a good teaser in your subject line. Again, these guys are getting 50 warm intros a day. You want yours to be opened and read. You got to stand out. So there's your teaser. Then in the body of the email, this is very short. good meeting you. I'm raising a seed round, a little bit about what we do, right? Almost a very, very minimalist elevator pitch. I would like this intro. Here's a little bit about why I want this intro for this particular investor. And then I've customized this because I noticed in LinkedIn that he went to the same college as my dad. And then I include a link to our pitch deck. Some people like to include the pitch deck in this first one, others don't. That's okay, it's kind of a judgment call. The key point is making this very easy for my connector to forward along. And the rule of thumb or the standard is always to do the opt-in approach. So I'm just asking my connector to send this. Jeff only has to hit forward and say, hey, Clint, do you want to take this intro? Let me know, forward. And if I'm asking for 5 or 6 intros, it's really important to make it easy for my connector. So just kind of a funny slide here, but you guys have seen this show, I'm sure, where HBO Silicon Valley, where they're out fundraising. It really has a lot of, captures a lot of the nuances of the reality of raising money. You know, you're getting out there pitching all these very smart, successful, large ego investors, and maybe it's not your own nature. These guys are professional investors. It's what they do all day long, is listen to pitches. This might be your first time, and maybe you're introverted, and maybe you're a technical founder. You're not a hustler type. It might not come as second nature to you to get out there and pitch, especially when you're going up against professionals. But you've got to switch into hustle mode, one way or another. A few hustle tips. So, we followed along this process. We built this target list. We qualified it. We figured out how to reach everyone. We have our pitch deck, model, executive summary, all ready to go. We start asking all our people, all our connectors for intros. And I'd say do this in parallel. We call it the Blitzkrieg approach. And what we're trying to do is really get momentum going around. Investors, every time you meet with investors, they're going to ask you, so tell me about your round. How's it going? Where are you at with your round? Where are you at with the round? You'll get that almost every time. To the extent you can say, we just started, but I've got a dozen meetings lined up this week and 14 more next week. It shows there's interest. Investors are driven by greed and FOMO, fear of missing out. So, if you've got a round that's showing momentum, that makes everyone pay attention a little bit more and move a little faster. And the best way to generate momentum is by having a lot of meetings. While you're in these meetings, or after these meetings, technically, you want to be coming back and refining that pitch deck that Cirque has mentioned, right? Every meeting you have, especially the first, say, 5 or 10, say 5 meetings, you're going to get a lot of feedback. You're going to realize some of your slides, even though you spent a lot of time on them, aren't clicking. They're confusing. The message isn't sticking. And so you've got to kind of continually refine your deck. When we actually raised our round, I was on version number 42 of our pitch deck. No exaggeration. It's been 42 iterations of our deck, and it was really, really tight by the end. It started out tight, at least I thought so. By the end, it was a masterpiece. And every day I'd come back from pitching and spend an hour at night revising a couple slides, right? A couple other things here on hustle tips. You do have to keep moving everyone. Another reason for thinking of it as a funnel, again, you're sort of thinking of moving everyone through your funnel from left to right. You're trying to just get people through your funnel into contact and pitch, into due diligence, ideally into committed column, but if not into committed, into the no column. You're moving everyone through your funnel, and you do have to follow up quite a bit with folks. And then also be sending regular updates to everyone you're talking to. One of the things I always kind of pound the tables on is you should be sending, when you're fundraising, you should be sending a monthly update to everyone who has not told you no. Even if they've been, not super responsive or reactive, you should be sending everyone who has not said no a monthly update. After you raise money, I kind of usually say maybe switch that to every other month or quarterly. I just did our quarterly update today. But fundraising, send your monthly updates regularly. And the reason is you've got to stay top of mind with these investors. As I mentioned, these guys are getting 50 to 100 intros a day. Many of them are having 4 or 5 pitch meetings a day, 20, 25 companies coming through the office a week. You've got to stay top of mind, and sending a monthly, progress report is one way to do that. A couple other hacks and tips here. Doing some retargeting ads. We experimented with this when we were fundraising, and I had a couple angels that did end up writing some checks. Mentioned that every time they logged into Facebook, they saw our ads. So I think it had some subliminal effect in keeping our message top and front and center. And again, it's the same thing as doing the updates. You're staying top of mind with these investors that are seeing so many companies and so many deals. So if you're doing a monthly update, doing some retargeting, maybe you have a PR firm and you're going to be getting some press, getting some coverage in TechCrunch. All that stuff helps you stay top of mind in a very noisy environment. Once you've done your pitch deck, I always say use Foundersuite or DocSend or Google Slides. One way or another, I like to put my pitch deck up online so I can include a link in my email instead of actually attaching the pitch deck. The reason is I'm constantly tweaking that slide deck, right? If you attach a PDF, it's out of date, the moment it leaves your inbox. If you have something online, you can always go in and edit those slides. And so, the version that's referenced by the URL is always the latest and greatest. Facebook is another place to find your mutual connections. While you're fundraising, there's some other kind of ancillary things to explore, like AngelList syndicates. AngelList syndicates, which is an angel who has a network of backers. They can usually do $100,000 to $300,000 checks, but almost always they're filling out a round. They're not starting a round. They're usually, taking the last 1/3 of a round versus leading it. Angel groups too can be useful to explore in the Bay Area here. There's probably half a dozen different angel groups. They take kind of a long time to get in front of them. Usually you've got to apply and go through some screening committees, so it can be a couple months before you're actually pitching to the angel group. And then crowdfunding is its own, entity we spent a lot of time talking about. But similar to the AngelList syndicates, crowdfunding isn't typically, equity crowdfunding is what I'm talking about, isn't typically a great place to source your round. If you already have half of your round committed, then it could be a good place to fill out a round with some fans and backers. But you see a lot of companies go on crowdfunding and raise $5,000 on a $100,000 round, and it just looks bad. It really looks terrible. I'm going to skip this in the interest of time, but sometimes we adjust the amounts of we're raising to always show that our round is half to 2/3 full. So sometimes we'll start to raise $500K. As that gets filled up, we might bump that up a little bit. We can cover that in the Q&A if people are interested. Finally, closing your round, which is always a challenge. Couple tips here. I'm going to go through very fast. Every pitch meeting you have, before walking out of that room, actually ask them if they're interested. Ask them their level of interest, and you can tell a lot about how the investor responds. A lot of times you'll just get the, let me think about it, or let me talk with my partners and I'll get back to you. That's fairly weak signal. If instead they say, why don't you come in next week and meet with my partners? If there's a next step, that's always a really strong signal. And then also, turn the tables back on them and say, if we were to do a deal together, how would you actually help out Foundersuite? How would you help our company grow? Make them pitch you a little bit can kind of be a good power dynamic. And then ultimately, once you start to get some momentum going around your round, now you can actually start to be selective about who you let into your round. And if you're able to do that, investors just go crazy because they all want to be part of a round that they can't get into, right? They all want the competitive deal. So you want to kind of create that momentum and dynamic. You know, and that happens once you've had a couple meetings that are going well with someone who can lead a deal. Once you get that first term sheet, you can of course go to everyone else you're talking to and say, hey, I've got a term sheet looking to close this in the next 3 weeks. You know, are you in or out? Do you want to put down an alternative term sheet? I mean, you can use that first term sheet as a catalyst. I mentioned, you know, you need to follow up frequently with these guys and gals. And a lot of times you just stop hearing from them. They ghost on you. I wouldn't worry about that. Actually, I'll show you one last little thing. I have a column in Foundersuite. I have a hard no column, and then I have a no response column. So, you know, you get a lot of people who just don't respond. Just deal with it, move on. If they haven't responded in like 3 emails, they're probably a no response, which is the same as a no. And when someone does say yes, you know, I'm not going to go into this too deeply, but Paul Graham has this handshake deal protocol where you basically get them to put it in an email that they're in, then you can consider them an actual commitment. Finally, don't let up until these wires actually cross the bank. I've seen many startups kind of take their foot off the gas pedal when fundraising, and the round loses that precious momentum and falls apart, even though they've spent a couple months chasing the money. And then, you know, our money shot here, drive it over the line. Final slide, put it all in perspective. You just raised, you know, you went in with your wonderful model that the EGF guys helped you put together. It showed what you're going to do for 12 months of runway. You raised enough money for 12 months of runway. That really means you need to start fundraising again 6 to 9 months from now, really 6 months from now. So, you know, get back to hustling. And that's it. Oh, I just wanted to add one plug. I hope you don't mind, but we did start this Facebook funding hacks group. So if you're interested, and hopefully, Jason, we can put this webinar on this funding hacks group. That's it.
Yeah, so why don't you pull up that slide there for us, Nathan? We'll jump into Q&A. We've got a few minutes here, and we've got the contact info there on the screen. So if we don't get to your question, please feel free to reach out to either or both of us. We're happy to help you guys out. And as a very quick reminder, we've got this webinar is going to be recorded, and it'll be sent to all registrants within 48 hours. So you'll have that available to you as well. Let's jump right in. Interesting question, Nathan. I'll give this one to you. When is it appropriate to court unaccredited investors? And if so, are there any particular guidelines?
Yeah, it's tricky. I mean, this whole Jobs Act, Jumpstart Our Business, that was supposed to be in effect a couple of years ago, was going to open up the world of raising money from unaccredited investors. And I can't, you know, you really should ask your attorney, but your attorney's going to say you can't. I've asked that question. It's a little bit murky right now how much you can solicit from unaccredited investors. You know, the other issue when going for unaccredited investors is if they're not accredited, that means they don't have net assets of, I think, $1 million or net income of $200,000 or $300,000 a year. So you're kind of raising money from people who maybe aren't able to afford losing that money. So it would make me really nervous if I know I'm taking Aunt Edna's, you know, $50,000 of her retirement savings that she's going to depend on to invest in Foundersuite. So as a general rule of thumb, I would try and avoid raising money from unaccredited investors unless it's your absolute last resort, because there are a lot of strings attached to that.
Nice. You know, it kind of plays into that the friends and family round, right? That early pre-seed round where, you know, like you said, it's Aunt Edna's like money under the mattress, or maybe it's your grandfather lending you $1,000, 5,000, 10,000, 100,000, whatever it is, and it's just like borrowing money from friends, right? There's a certain and unique expectation when dealing with friends and family and money, especially for this larger dollar amount, where things can get very tricky and sometimes, unfortunately, ugly very quickly. So, some very good points there, sir. Let me throw one your way real quickly. We talked a little bit about financial statements early on in the pitch deck. Do you recommend having the actual financial statements in the deck, or should that be kind of an appendix type thing that Nathan mentioned earlier?
Yeah, no, you won't want the full financial statements in the deck. You're going to want to put in a visual of what it looks like, and you can kind of look at different ways of presenting the information in a visual format. You're going to want to have the full financial statements as appendixes.
Gotcha. Okay, so I'll one more question that we'll hit here, and I'll let both of you take a stab at answering here. If you're out fundraising, I'll see if I can paraphrase this. If you're out fundraising and you've gone a period of time and haven't raised any money yet, is that a particularly bad sign, or should you have an excuse ready? Nathan, I'll throw that to you first. If fundraising is starting to turn into the desert, like how do you kind of spin that for any future investors to try to get that money coming in?
So I'll answer it a bit with a joke used to make for consulting. Is that investors have a detector built into their door frame when you walk into their office that it can smell momentum or it can smell desperation. Right? Desperation sensor. And there's a little green light that you can't see that goes off when you walk into the office that signals whether you have momentum or desperation. But reality, all joking aside, like two answers to that. Like if you've been raising around for a while and it's not clicking, you're not getting momentum, you're not getting buying signals, there is a signal that investors can pick up on that it's getting stale, right? Because again, they're all looking for that momentum deal that has competitive dynamics to it. So if you don't have that, people pick up on that. The other thing is, if you've been fundraising for 3, 4, well, let's say 5 or 6 months at the extreme, and you're just not getting buying signals, there's something probably fundamentally wrong. Either you're too early, or maybe your deal isn't really a venture or angel type of deal. So you might spend some time in the mirror or with your advisors or with your service providers and really trying to figure out, what's the problem here? Is it my pitch? Is there something fundamentally wrong with the deal?
Yeah, that's a really, really good point, and we do see that, right, where either the financial model, the business model, the market opportunity is just not it's not a sweet spot, right, for venture investors. Maybe the revenue growth isn't as big, or the market size isn't as big. As long as it's not something about kind of your individual like management team, or you're just not hitting it off. A lot of times it can be that, hey, maybe this isn't the kind of business that is going to be attractive to venture investors, and maybe we should be looking at other types of funding vehicles.
Gotcha. Okay, great insight, guys. Thank you for everything you brought to the webinar today. We're gonna put a pin in it right there and wrap it up. Again, real quickly, contact information is there. If you have any pressing questions that we didn't get to today, we do encourage you to reach out. We're happy to help. Again, Sir and Nathan, thank you both for joining us today and lending a lot of expertise. This has been great. And to everyone that attended, thank you for joining us. And everyone have a good rest of their afternoon and their week.
Thank you, everyone, and good luck.
Thank you.